Hello, my name is Antonio Garcia. Today, from our channel Gagra Trading, I am going to perform an analysis and expectations of the American stock market, especially the S500. Before we start, let me warn that what I indicate in the video are my opinions and do not constitute a buy or sell recommendation. To carry out the analysis, we are going to divide it into macroeconomic, technical, and quantitative, intertwining the different analyses to draw conclusions. Well, let's get started. In the macroeconomic field, I consider that inflation is no longer the main problem, showing unequivocal signs that it is decreasing, both general and underlying. Thus, one or two maximum increases of 25 basis points in interest rates would be the most likely scenario. The important thing is to know whether the Fed will keep interest rates high for several months, well into 2024, or on the contrary, it will start a rapid drop in interest rates in the face of bulky economic recession data, which would scare the Federal Reserve, causing a pivot from rising to falling interest rates in an accelerated way. In my opinion, the best scenario for the stock markets is a quick pivot. That is, the Federal Reserve goes into panic mode, lowers interest rates, and opens the floodgates of liquidity to the system, which is very likely to catapult the American stock markets to break historical highs again. On the other hand, the worst scenario is that the economy does not cool down and interest rates continue to rise or remain high for a long time, which would drain spending capacity from American consumers, causing systematically poor business results, and the stock market should trade it down. I believe that the Federal Reserve, while taking on the role of being very tough on the economic level, giving a violent speech to investors, is actually yearning and wishing to return to the monetary stimulus programs prior to 2022, becoming a friend central bank and not an enemy for investors. Without a doubt, there are negative tailwinds that we must closely monitor at the macroeconomic level. We are going to list and analyze them. The first is the magnitude of the impending economic crisis. It is not yet clear whether it will be mild or severe, and above all, if there are Fed monetary policy mistakes. That is, if Powell goes overboard with interest rate hikes and causes an economic disaster. The second, the office asset crisis that exists in the United States. Sooner or later, it will affect the balances of regional banks again, generating turbulence in the financial market. On the geostrategic level, we must watch the war between Ukraine and Russia. A positive catalyst would be the end of the war. As negative, the use of tactical nuclear weapons or the active entry of NATO into the conflict. Of course, we must always consider tensions between China and Taiwan. In summary, at the macroeconomic level, we are at a very complex moment where we cannot operate only with macro. We must complement it with a technical and quantitative analysis, and under no circumstances go short, because the macroeconomy is bad, and we assume that therefore the stock markets will go down. This simplistic analysis usually leads to considerable losses. Well, let's go with the technical plane. We observe that the SPY 500 has broadly broken 50's Fibonacci retracement, which historically has meant the end of the bearish trend, and that new lows or floors are not seen. We observe that we are in a short-term bullish trend above the different moving averages, making a pullback with a journey to the 61.8 Fibonacci retracement. Personally, I believe that if it breaks the previous maximum of 4,800 points at 4,500 points at 4,550, it will become a magnet. Below, I think the 61.8 Fibonacci and the different moving averages are going to be a very complex task for the bears, with a maximum journey to the 4,000 points, 200 moving average. As we can see at the technical level, the SPY 500 is not bearish, and although the macroeconomic analysis is discouraging, the technical section offers us a bullish vision. Going short looking for a sharp drop from my point of view is not advisable. Finally, in the quantitative section, There is no longer excessive fear of drops. Money flow entries have been made into the stock indices. Similarly, fixed income, state and corporate bonds have stabilized. We are in a cycle of low volatility, which is a positive scenario for the indices to continue rising. As a conclusion, I see greater possibilities of testing the historical highs in this 500 than looking for a new floor below the previous minimum at approximately 3,500 points. Likewise, sectors like IE in baby bubble mode are helping the index go up, however, with no market breadth. The 7 values with the highest capitalization are responsible for this 500 entering a short-term bullish phase, and not the remaining 493 values that haven't risen much. This can be good or bad. Good if these 493 values activate upward, the potential for rising is enormous. And bad if the divergences between the 7 biggest and the remaining 493 continue to increase. It could result in the 7 magnificent correcting and dragging the market. Always remember to monitor volatility. The indices are asymmetrical. They tend to rise with low volatility and slowly and steadily, and drop with high volatility and in few sessions. I hope you liked this video. Subscribe and like to support us.